All right. Temporary low. Never try to say this is the low of the day. You're just trying to maybe eventually you'll get if you could predict 2 points, that's what you have to predict before you predict 20 points. So don't ever anytime say this is going to be the low of the day. This is going to be the low of the day. Just trying to predict temporary lows and then go with the flow and see when that could change. A few things right at this point created the big pop that we got at this moment in time. It's always a snapshot. So at this moment in time, we had clues from way back in here that it was going to be bearish. A couple things happened though that signaled there could be a temporary jump. Number one, we got underneath the prior day's low, which a lot of people who are long are probably going to take a sell stop and puke it and take their loss from that long, which creates less longs, less sellers. So when I play this, you're going to see this market dip down and this green kick out. What this means, when you look at it up here immediately, you see that this is by far the two biggest long pukes of the session. One at 28 when it came down in here, and then this one below yesterday's low when it came down here. So you expect this one took a little longer to pop, but it did after all these longs puked. This one has an expectation to pop, especially when these greens go away and reds come in. So if I play it, you're going to see another iceberg come in, which is typical for maybe a pop. You're going to see the reds come in, which are people trying to sell it, but they're late. You're going to see these longs right there file down. You obviously are going to have the longs piece. You got less longs, which means less sellers above. You got more shorts, which means more buyers below. And you can see that it's probably going to jump, and it does jump. And then our laser goes from green to red. So you get all those things. Doesn't have to be the low. You got to get good at predicting the next 2 points, 3 points before you try to predict the next 10 or 20. Get good at the first 2 or 3 because it's got to move 2 or 3 your way before it moves 10 or 20. And everybody's looking to predict 20, but they're not used to taking the heat that you have to take to get 20-point winners. All right. You're not used to taking the heat that you have to take, which isn't really heat, but the risk that you have to take in order to get 20-point winners. And what happens a lot is you're looking for too much on the reward side, and you end up leaving a lot of money on the table on a lot of trades. You'll get 4 or 5 point winners, and then there'll be a loser. They'll turn to a loser, and those suck. Those are going to wear on you one way or the other. It's emotional capital. There's a lot of emotional capital that is part of the business. It's not just hard capital, it's the emotional capital. And if you get yourself into a situation where you buy it here, you did get it to rally there, but you're looking for it to go all the way up here, and this is a 4-point winner, but this is a 15-point winner, and that's your target, and it goes 4 or 5 points your way, and then it comes back and stops you out for a 3-point loss. Well, guess what? That's a 7-point turnaround, up 4 to down 3. All right. Your statement shows you're down 3, but your body, your emotion, seeing it go +4 to -3. You're going to feel this 7-point swing. That's real money. And it doesn't mean that you have to take smaller winners, but you have to do a better job at qualifying when, hey, if you're able to get 2, 3, 4-point head starts, almost like most of the time, that's the key. That's picking good locations, no matter what your runners might be or what the tail might be. The definition of a good location is a minimal amount of heat and it start going your way as soon as possible. Does it have to go right away? No, we'd like it to, but that's the real definition of a good location is you buy it and bam, it goes up right away. But that's not always going to happen. You want to take a minimal amount of heat in order for it to go up. Because if you were always expecting I'm going to buy it here and I'll take 8 points of heat or 6 points of heat or 4 points of heat, and generally I take that much heat, well, that's kind of crazy. Then why wouldn't you get better at finding better locations? You always are expecting to take this amount of heat, then you should find better locations. If you're always expecting it to go against you this much, then you got to do a better job at having it, tighten that up a little bit. Some people have it too tight. Some people have it too wide. When someone says, where is a good, how much to risk, man, that has a lot to do with the type of day it is. It also has a lot to do with will you tell me what a good update, a good target is? What are you looking to take out? Because that has a lot to do with what you're going to risk. I remember the first financial advisor that I met with, I was in my early 20s, early 30s when I started doing really well 20 years ago. And he says to me, what do you consider a big, nice return on your money year over year? And I said, well, that has a lot to do on what you consider a bad year. If I tell you 10% is a good year and you tell me 30% down is a bad year, we got a problem. And so that's always thinking risk reward. And if you're looking for big winners, you're going to have to risk a little bit more, and not just in hard capital, but in emotional capital. And if you're getting yourself beat up because you see it go your way against you, your way against you, your way against you, that's the way it's generally going to work to get 20-point winners in the S&P. So you better not be surprised by the roller coaster of emotion and not be on that roller coaster, because you expect it to do this in order to go 20, because 20-point winners in the S&P is a lot. On real super volatile days, it's not. It goes 20 points sometimes in swings, but 20-point moves is a nice move. You could catch it, but you're not going to risk 2 ticks to make 20 points. I think people should know that. Also, part of this highlight is popular places to put your stop. Find out where the little Johnnies are. Where would be an obvious place for little Johnny and a 5th grader to put his stop, and then don't. Because if it's obvious to little Johnny and a 5th grader, it's obvious to most of the rest of the world, and you're going to have a lot of longs most likely put a stop in below a prior day level, prior day low. Longs, say, well, if it gets below here and it's yesterday's low, that's why it was a popular sell stop. That's when it goes green, that means longs puked. That's why it's green for longs. But how do longs puke? What do they use? What do most longs use order type wise to get out of a long position? What order type is most popular? A sell stop below the market. Everybody would mostly get that correct if you thought about it. So if a lot of sell stops come out, it's easy and very accurate to presume that they're longs puking. And the whole key, and this is the cheat sheet, less longs equal less sellers above. Less sellers above, it's always easier for price to go up. And that's the point of trading, is not to predict prices going up after it goes up, but before it goes up. It's easier to say, hey, we're going to pop a little bit after it pops a little bit, right? But you're not going to get paid on that. You have to be good at predicting and knowing where you're wrong. The best skill you'll create is being good at being wrong. If you're not good at being wrong, you're going to be stubborn and you're going to do some stupid SHIT. Don't do the stupid SHIT. Just going back to this though, just everything lined up. You had an iceberg buyer that came in after a break. You had shorts pile in. You had one of the longest long pukes, and it rallies, and now it's not random anymore. And that's what lights everybody up. When you're able to make a call and it doesn't seem like a guess.